Okay, here we go. This is PA2-8, recording manufacturing costs, preparing a cost of goods manufactured report, and calculating income from operations. This is the last assigned problem for Chapter 2, and I think this is pretty close in terms of what is required for that other assignment for Chapter 2, that discussion case SDC2-3, which is also assigned for Chapter 2 and due this coming Sunday. Of course, for that problem, excuse me, you need to use Excel and or Word and submit your assignment solution through the assignments tool. But anyway, let's take a look at PA2-8 in Connect. Okay, Dobson Manufacturing Company uses a job order cost system with manufacturing overhead applied to products on the basis of direct labor dollars. Okay, so this allocation scheme is more like problem 2-1 and 2 that we worked on earlier. At the beginning of the most recent period, the company estimated its total direct labor costs to be $55,900 and its total manufacturing overhead costs to be $111,800. So again, we talked about the process of estimating certain costs in a manufacturing concern where overhead allocation or overhead application is required throughout the year from beginning to end. And so it's based on estimates made at the end of the year. Estimates made at the beginning of the year. And of course, those estimates would be based on historical data. You know, what has occurred over the past, several years, be it 3 to 5 or what have you. And those two components, direct labor cost and total manufacturing overhead costs, are the two variables that go into the calculation of the predetermined overhead rate. And so that's the first requirement for this problem. And I'm going to use an Excel spreadsheet like I did in the previous problem to just show the calculations just in rough format. And so let me bring that over here. And so our predetermined overhead rate, percentage of direct labor costs, we take our estimate of overhead for year and divide it by our estimate of direct labor for year. And those amounts are $111,800 for overhead and $55,900 for direct labor. And so the rate is based on that ratio, dividing one by the other. So our predetermined overhead application rate is calculated by taking overhead and dividing it by labor. And so we need to format that as a percentage. And we see that it's 200%. In other words, for every dollar of direct labor incurred on a job, we allocate $2 of overhead to that job. Okay, great. And so we'll want to put that in, 200% of direct labor costs. And as we have done throughout working through these problems, we want to do a quick check my work, see that we're okay, and we are. So we can move on. You know, I think it kind of helps as you work through these problems to kind of verify your own work as you proceed through the problem. I think it helps to build a sense of confidence in your own understanding and ability as you start and work through and finish each problem. Okay, and that's really why I've always made that check my work feature available in Connect, because you know, in the old days when I was going through this in college, you know, there were no computers. Everything was pencil and paper. And you know, when it came to homework like these problems, you know, you'd have to work them on your own with absolutely no help or guidance of any type except what you could find in the textbook, and then hand them in and then wait however long you needed to wait for the prof to get through them and correct them and get them back to you, and then you had to look at it and see what your errors were, and then, you know, go back and try to figure out where you went wrong, etc., etc., etc. So with these technology tools, I mean, it's like night and day from the old days. But anyway, that's a war story. Okay, number 2 required, fill in the missing values in the T accounts. Okay, this is a little bit tricky compared to what we did in the previous problems, because filling in missing values requires a little bit more understanding of the process. And so let's take a look at what we have here. We have a raw materials inventory account. We have a beginning balance. We have purchases. And we have an ending balance. And this is a debit, this is an asset account. It's a debit balance account. And so we know that the amounts on the left side are added and the amounts on the right side are subtracted. And so if we start with the beginning balance, and let me get the Excel sheet up here. Instead of doing this off screen on my calculator, maybe it's more helpful if we use an Excel spreadsheet to do the calculations, and that way you can see what's happening here as we calculate each of these missing values. So let's see, this is raw materials inventory beginning balance and that's 13.4, and then we are adding raw materials purchases, and that's 93.5. And so if we added these two amounts together here, 106.9, what would be a good description of this calculated total, 106.9? Well, what it is would be raw materials available for production. Raw materials available for production, 106.9 is what we had plus what we bought. So what's available is 1069. And then what we need to calculate, as you can tell, as I hope you can tell by looking at the T account, is the credit. And the credit represents raw materials taken out of inventory and moved into production. And so the way we do that with the information given is to subtract the raw material inventory ending balance. And so we show that as a minus 29.3, and that should give us, if we calculate that total first of all, what was available less what we ended up with gives us 77.6. So 77.6 would be our raw materials transferred to production, 77.6. And so the next step, of course, is to put that in there and take a quick look at, check my work, and we can see that 77.6 is correct. Okay, so doing it this way, obviously it's going to take a little while, but you know, I think it'd be helpful for most of you to go through this step by step and try to get a feel for what's happening here. Okay, so when we apply raw materials to production, we are moving raw materials into work in process as direct materials, and we are moving raw materials into manufacturing overhead as indirect materials. So if this is our credit for that transaction, then the total of these two amounts, 69.8 and 7,800, should be this total here. And it looks like it is, but we need to show that on paper. Let me get rid of these extra columns at the top. Okay. Oh, what did I do? There we go. Okay, so our raw materials to WIP, work in process as direct materials, is right here at the top of that Excel spreadsheet, 69.8. And our raw materials to manufacturing overhead as indirect materials, we can get this spreadsheet out of the way here, and that's the debit to manufacturing overhead indirect materials, 7,800. Well, the total of these two amounts should be the amount of our credit to the raw materials inventory account, which it is. So we know that that amount represents raw materials. In fact, we can just copy this and move it there. There we go. Okay. So that's just a confirmation of what we did for the first calculation. Okay, so in our work in process inventory account, now keep in mind that work in process inventory represents our goods in production or jobs in production. This is the account that this is an asset account, it's an inventory account, and this is the account that we use to accumulate and keep track of our material, direct material, direct labor and overhead costs for each and all of our jobs. So if you understand the concept of a subsidiary ledger, like we use for accounts receivable and accounts payable, where we have a control account, that being the ledger account for, let's say, accounts receivable, and whatever the balance in the ledger account in total would be for accounts receivable, we need a subsidiary ledger that shows the breakdown of that balance in total for each and all of our customers. Okay, so that's basically the concept of a subsidiary ledger. So just as we do it for those types of ledger accounts, we also use a subsidiary system for work in process inventory for manufacturing. So in total, our direct materials added and direct labor added and overhead added, and whatever our balance in this inventory account is, we need to have a separate set of records or a separate set of ledgers that shows the breakdown of these costs by each and every one of our jobs. And I think you might have been able to get a better idea of that when you work through problem 3. But anyway, here in the ledger we are working in totals. So we see that we had a beginning balance in work in process. This would be our balance forward from the previous accounting period, 28-2. And then we added direct materials to production, and we added direct labor to production. And we need both a credit and a debit here. And so we have two variables. And so I think if you thought about this for a minute or two, you would see that the order in which we solve for these two variables is probably such that we need to calculate this debit first, and that would make it easier then for us to calculate this credit, because it'd be almost impossible to calculate the credit with a blank here without first calculating the amount of this debit. And so let's see if we can do that. And that debit is for applied overhead. And so it helps to know what the entry is for applied overhead. And overhead applied is basically calculated using the predetermined overhead rate, which we did up above. Can I move this out of the way? Here we go. That might make it easier. Oh, it just got bigger. I didn't want that to happen. Okay. We used the predetermined overhead rate, which we calculated in number 1 above, which is 200% of direct labor. And we calculate overhead applied to production by multiplying the direct labor cost incurred, which is 40,400, by the predetermined overhead application rate, which is 200%. And so let's show that here on this spreadsheet. So we take our actual direct labor cost incurred, which is given to us here as a debit to work in process. By the way, what would the associated credit or credits be for this debit to direct labor? Well, it would be the various payroll liability account credits, like federal withholding, state withholding, FICA and FICA withholding and any other withholdings and the accrued payroll credit. So our direct labor is 40,400. And our predetermined overhead application rate is let's see if this will work here. 200%. And so our manufacturing overhead applied to production would be calculated by taking actual direct labor and multiplying by the overhead application rate. So we take the direct labor amount and multiply by the direct labor, by the application rate, and we see that that's 80,800. And so that should be the amount of our credit to our manufacturing overhead account for applied overhead. And when we apply overhead, we basically take it out of manufacturing overhead with a credit. Manufacturing overhead is an income statement account, and it's a cost account, and so it carries a debit balance. And so to reduce it, we credit it, and in this case we call that credit overhead applied, or applied overhead for production. And so the debit is to move this amount into production, and that production those production costs again are being accumulated in our asset account work in process inventory, and we show that as applied overhead. Okay, so now instead of checking this out in Check My Work, let's go ahead and calculate the credit to this account. And we can do this the same way we calculated our credit in raw materials inventory. And so again, let's show that this is taking up a little bit more time, but let's show that on our Excel spreadsheet here. So we have work in process beginning balance, and that's 28.2. And then we have our direct materials added to production, and we have our direct labor added to production, and then we have our manufacturing overhead. And instead of saying added, I'll say applied. That's more appropriate terminology. And so we can get these three amounts right off the T account, 69.8 and 40,400, and then the amount we just calculated up above here for overhead applied, 80,800. And then if we take a total of these four amounts, we can see that the total cost we had or began the period with, plus the costs we added for the period in terms of material, labor, and overhead, gives us a total that we could probably call total manufacturing costs in this period, or what would be a better term? I think total manufacturing costs would probably be the best term to use for that total. But as you can see, this is total manufacturing costs, well, let's say in work in process. But you can see that we ended the period with a balance that is substantially lower. And so if we subtract that ending balance, 19.1, then that calculation, which is $200,100, represents the cost of jobs that were completed during the period. So in other words, we're taking those jobs and all of the cost for all of those jobs out of our work in process inventory. So let's call that cost of jobs completed during period. Let's move that out a little bit. Okay, 20,200, I'm sorry, 200,100. And so let's plug that into the credit side of our account, and then now let's go down and check it. So we check in two calculations, the 80,800 and the 200,100. And let's see, hopefully we're okay, and the 80,800 is okay, and the 200,100 is okay, but this entry isn't complete just yet. So we are taking the cost of jobs completed out of work in process, and where do we then keep our completed jobs? Well, we keep it in our finished goods inventory. So the debit to finished goods, and they're showing it as cost of goods completed. On my Excel spreadsheet, I'm showing it as cost of jobs completed during period. So essentially that's the same thing. Cost of goods completed, 200,100. And we can see again that there's a credit that we need here. And if we look at the beginning balance plus the cost of jobs completed and compare it to the ending balance, we can see that indeed we do need a credit amount. And what does this credit now to the finished goods inventory represent? Well, again, this is where our finished jobs are being held on our books until such time that they are sold, at which time we need to take the cost of those jobs out of our finished goods inventory. And again, finished goods inventory, asset account, debit balance account. So a credit is used to reduce this account. And so the cost of those jobs sold during the period would be represented by this credit. And notice again, you know, in the previous problems, we didn't the transactions were actually given to us, and we needed to record them. So here we're given certain T account information with amounts on those T accounts blank, and based on our understanding of the flow of costs through our accounting system, we need to recreate those missing values, and so that's what we're doing here. So again, going back to finished goods, we have the beginning balance, we have the cost of completed jobs added to finished goods. And again, let's take the time to show that on our Excel spreadsheet. So our finished goods inventory beginning balance is 41.3. And then our cost of jobs completed during period is 200,100. And then if we take the total of those two amounts, 241.4, then what could we call that? What would be a good description? That would be the cost of jobs available for sale. That's the total cost of all our finished jobs, and they are all available for sale. And again, we can see that our ending balance in that inventory account is way less than what was available for sale. And so if we subtract that amount, $49.5, and take that total, we can see that the 191.9 represents the cost of jobs sold during the period. 191.9. And so if we show our credit to finished goods, 191.9, and when we sell product, where does the cost end up? The cost ends up in cost of goods sold. And I'm not sure I like the way that they're describing this here, 191.9. They're saying it's unadjusted cost of goods sold, and that's technically correct, but I would rather show that as a cost of jobs sold during the period. Excuse me for one second, I got a phone call I need to take. Okay, sorry about that. So we were looking at this entry to record the cost of finished jobs sold, and so that calculation we did on our Excel spreadsheet, and we show that entry as a credit to finished goods inventory, taking the cost of those jobs sold out of finished goods inventory and moving that cost into our income statement account, which is a cost account called cost of goods sold, or probably a better title for this account in a manufacturing concern using job cost accounting would be cost of jobs sold. Okay, just an FYI, something to think about. So that amount is 191.9, and let's do a quick check. Make sure we're still okay. And you know what we're looking for all the way through is the green check marks. Yeah, when we see the red X, that's what tells us that we have an error. And as you can see up here, answer is not complete. What we have here so far is all correct, but there's still some other values that need to be entered. Therefore, the answer in total is incomplete. Okay. So we're almost done with the T accounts. We have cost of goods sold recorded, unadjusted, and we have our manufacturing overhead account. It looks complete, and you know, it looks like it's something that we can just accept as is, but I think it's probably a good idea to just double check the calculation, and we can easily do that on a calculator. And so I'm just going to show these amounts: indirect materials, indirect labor, factory depreciation, factory rent, factory utilities, other factory costs, and let's see what those amounts are here. 7,800, 14,3, 11 to 7,000, 2,500, and 9,700, and then we can take a quick total on that amount and show this 52.5. Well, what does this represent? As we see here on the account, it's actual overhead incurred. Actual factory overhead incurred, and then we subtract less manufacturing overhead applied to production or credited out of overhead, and that amount as shown here, previous calculation, is 80,800. And so if we take a balance of the account at that point, we see that the balance is a negative amount. Now, this being an overhead account, income statement account, a debit balance account, if it's a negative amount, that means our credit side total is higher than our debit side total. So our actual overhead was 52.5, and we applied 80,800. Therefore, we have over applied manufacturing overhead to production. So and they're not asking for us to show that balance here, but that's the amount of overhead over applied, 28,300. And so this is adjusted, this amount in the overhead account, be it a credit as it is here or a debit as it could be if overhead had been under applied. It'd be a debit balance if our overhead, our actual overhead was actually more than what we applied to production during the period. Either way, the overhead account needs to be adjusted to zero because again, this is an income statement account. All income statement accounts, be they credit balance accounts or debit balance accounts, are closed or adjusted to zero at the end of each accounting period. So the overhead account likewise is adjusted to zero at the end of the accounting period. So since we have a credit of 28.3, our adjustment to close the overhead account would include a debit to overhead of 28.3 and a credit and I'm looking at this and I'm thinking this doesn't quite look correct, and because the blank here in the cost of goods sold account is showing as a I see, they're not giving us a space to show the credit to cost of goods sold. They just are giving us a space to show the adjusted balance in cost of goods sold after the credit for over applied overhead. So let's show that here on the Excel spreadsheet. Let's show this as cost of jobs sold before adjustment, and that's 191.9, and then we can show the adjustment for over applied overhead. And again, since the balance in manufacturing overhead is a credit, to adjust it, we would debit manufacturing overhead and we would credit cost of goods or cost of jobs sold. So our adjustment in cost of goods sold is a credit, minus 28.3. And so our cost of jobs sold after, let's change that, after adjustment would be the total of these two amounts here, 163.6. And so let's plug that in there and cross our fingers and check my work. And let's hope that what we just did there is correct. And it is 163.6. So again, they're not giving us the empty space here to show the credit of 28.3. But normally this adjustment would be a debit here and a credit here to show that the over-applied overhead is being adjusted to cost of goods sold. Okay, and finally, well, not finally, but for this part of the problem, we can see that our sales is here, our selling and general and administrative expenses are here. Oh, here, cost of compute over or under applied overhead, and we already did that. That was 28.3. I'm sorry, 20. The number goes here, and we need to show that as over applied. And so let's check that as well. And we should see that, okay, number one is complete, correct and complete. Number two is all complete and correct. And number three is also complete and correct. And so what's left here would be the statements for requirement 4 and 5. And so with that, I'm going to shut it down here. I need to get a couple of things done. And I'll come back to this as soon as I'm able to finish up this problem. Hopefully what we've done here helps, and I'll see you guys in a while. Thank you.